Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. December corn was very much under pressure last week, as evidenced in the price action in the downward movement. The market continued to decline and has come down to our support level of 373.5. Right now we have two key support levels that we're looking at in the event that the market's able to break through the 373.5 number. The next key area that we would have on your radar is 366.5. So below 373.5 and 366.5, this area is going to be very much a key support as the market is now oversold. And now that we are in March, we believe that the market is due for a small bounce given the strong downward pressure that we've seen over the past week and a half or so. Additionally, in spite of the bearish information that we were able to get from the USDA Outlook Forum from last week, the market has held up reasonably well since that time. So historically speaking, we believe that a short-term bounce is perhaps due. Those very same levels happen to coincide with our volume at price technical analysis protocol. What you'll notice here is that the current low that sits at 373.5 happens to coincide with two standard deviations below the point of control, which is currently at 390.5. One standard deviation below that is 378. So what we would anticipate is potential lows to come in at near-term levels and for a bounce that maybe moves near 380 or so. If we're able to get past 380, we believe about 390 is about as high as the market would potentially go before turning back down into the early summer months. It is a well-known adage that when a market tests a support or resistance level 3 times, the 4th time the market will typically break that area or that zone. That is precisely what has happened here in the November beans contract. We'll notice that we've had our 3 tests at these 3 areas, and we long warned you that if the market came in and made a test for a 4th time, that we believe that the market would break. That's exactly what happened last week. The market came in to test for that 4th time, has since broken, and now we're looking at about 863.5 for potential support. This 863.5 number coincides with our 360-degree threshold from a previous signature pivot. And not only that, but we are also sitting at volatility-based support. So this area now for soybeans is potentially reasonable support in the near term. Now we do believe that prices will continue back down, but for now we're looking at near-term support for a short-term bounce because we are oversold, but we will perhaps again find resistance near the 893 area, and we could potentially see a marginal break just above that goes up to perhaps about 900. But much more than that is unrealistic for us right now unless something happens such as a weather event that really changes the narrative of what we're understanding with regards to the current supply scenario. Our volume at price analysis is giving us even additional insight as to where we live in our space. The point of control is currently at 889. One standard deviation below that is at 872.5. Well, 872.5 is very close to where we are right now. Market's currently sitting at 870 3/4. And so what we believe is if the market's able to hold support here, we could see a bounce up to about 889 or even 905. But much higher than that is unrealistic. But below that, in all likelihood, if we see additional weakness, we'd then be looking to make a move down to about 850. The wheat contract has been the most beat up of any of the underlying grains that we've been looking at over the past couple months. And we'll notice here that the market came into great resistance based off of our geometric shape. And upon bouncing off of volatility-based support, we found great resistance at that geometric shape, and we have since dropped back down to find lower prices. What we'll also notice here is we had our volatility-based support band. Once the market came into this region, it in fact did consolidate for about 5 to 6 trading days and has hence broken through, and now we're finding support at the next key level just below. Now we're finding a confluence of levels here that may actually hold the market sideways for a bit. But we also believe that the market is due to perhaps make it to about 440 before really finding good support. So as we look right now, the 440 to 445 area is our minimum price objective. Market currently is sitting at 455, so current price action has us making a bit of a bounce, but really the narrative for wheat has been oversupply and lack of demand, and not much has changed along those lines. So for now, we'll continue to monitor its price action, but the reality is wheat really is having a tough time being able to recover, and whenever it has much of a bounce, the short sellers come back in and push the market back down again. We'll wrap up today with a look at the crude oil market. What we have here is the April contract, and after having come in and made a very good double bottom inside the market here, we have since been moving higher, and we are near-term resistance, which is at the band between 320, or rather, which is at the band 3620 and 3658. This is going to be a very, very difficult area for this market to get through, and if it's able to do so, we really believe that the market will perhaps make a very fast acceleration up to about 4360. But as long as it stays below that area, there's the potential to make one more final low before actually turning back up again. The one thing I wanted to bring to our attention in particular is the upcoming potential turn date of March 11th. We have this projected as a future cycle date for this market, and we're only about a week away from this timeline. We believe right now if the market's able to continue to climb up into this date, we'll perhaps see a nice little turn for potential opportunity to the downside. On the flip side, if the market actually declines ahead of this date, then we're looking at a potential low. And so we want to earmark this date as a potential opportunity for this particular contract. Part of why we like this contract is what we've seen in the past. Back on December 21st, we've put in a small low, and other cycles prior to that seem to have been hitting fairly well with regards to its harmonic rhythm. As we look at the crude oil market right now, the demographic really tells us that in spite of all of the oversupply that we've seen, much of the bad news is perhaps behind us, and the market is actually finally able to start incrementally building some momentum, or at the very least is able to consolidate at near-term prices before trying to make its next move upwards beyond the 36 mark. Thank you so much for joining us for our weekly market update, and look so much forward to being able to help you again next week.